PantheonAI presents Bitcoin's at all-time highs, 30-year yield surge, JPMorgan Deploys Special Forces, Crypto Bill Buzz. Welcome back to the PAI Morning Briefing.
Thanks for joining us. I'm your co-host, and today is May 21st, 2025. Good morning, everyone.
Hope you're all settled in with your coffee or tea. We've got a lot to unpack this morning. Markets are definitely in motion, some really intriguing news stories, and maybe a few laughs along the way.
Absolutely. Let's just jump right into it, shall we?
Let's do it. Kicking off with a quick market overview. The S&P 500 is trading at roughly 5,932.5 right now.
Okay, and that's up about 0.37%. So a modest gain, maybe signaling some cautious optimism out there?
Yeah, exactly. Measured, as you said. Meanwhile, the Dow Jones is looking pretty flat, hovering around 42,354.9. Barely shifting. Just an uptick of about 0.1%.
Right, not much movement there. But over on the Nasdaq, things seem a bit more lively, huh?
Definitely. Trading at about 19,226.4, and that's an increase of over 1.16%. Seems like tech and growth stocks are really stealing the show early on.
No surprise there, tech often leads the pack. And the Russell 2000? How are the small caps doing?
They've just inched along, around 2084.2, with negligible change, so mostly flat there.
Got it. Now, what about the digital asset front, Bitcoin and Ethereum?
Good question. Bitcoin recently charted at roughly 108985.5, gaining almost 2%. And Ethereum is at about 2564.6, with a gain of nearly 1.6%.
Interesting to see the crypto market mirroring some of the traditional market movements today. Maybe investors are looking for alternative hedges in these uncertain times?
Could be. It's definitely a fascinating connection. Now let's dive a little deeper into some prevailing market trends shaping things today.
Okay, what's top of mind?
One of the big stories is the movement in government bonds, particularly the 30-year Treasury yield.
Yes, I've heard about this. The 30-year yield has crept back above 5% for the second time this week, right?
That's right. And that development has market analysts a bit on edge.
For those less familiar, how exactly do yields serve as a gauge for investor sentiment?
Well, when yields rise sharply, it typically signals a flight to safety away from stocks. And that often results in higher borrowing costs for companies.
Okay, so it's not just a number, it has real-world implications.
Exactly. And while a single data point doesn't define the market, repeated patterns like this can sometimes indicate a turning tide in investor confidence.
That makes sense. And this news about the 30-year yield isn't just a U.S. headline, is it? It's reverberating globally.
Absolutely. Multiple articles have stressed that this surge in bond yields could be a harbinger of a problematic period ahead, not just for equities, but for the broader credit markets too.
Wow, so investors who've been watching the government debt sector should really be paying attention now.
Definitely. It might be the moment to reassess your risk profile. Rising yields could mean higher costs for companies looking to expand, and even affect sectors heavily dependent on debt financing, like real estate and utilities.
Right, that could really slow things down in those areas.
Precisely. Now, as we transition, a recurring theme in today's news is the concept of Bond Vigilantes.
Bond Vigilantes? That sounds like the latest superhero team.
Haha, it does, doesn't it? But in our financial lexicon, it refers to those market participants, often institutional investors, who act decisively by selling off bonds, thereby pushing yields higher.
Okay, so they're actively influencing the market by selling.
Exactly. And reports are indicating these vigilantes aren't just staying within U.S. borders, they're circling the globe.
Globally? What's driving their actions?
Concerns over worsening fiscal situations around the world. That's what's sending shockwaves across global bond markets.
So, in a way, it's like a global game of red alert, where every sell-off is a wake-up call, signaling that fiscal imbalances could have far-reaching effects.
That's a great way to put it. It's a clear signal from the market itself.
Speaking of global implications, let's consider the interplay between these rising bond yields and the equity markets.
Yeah, it's a critical connection. Higher yields raise the cost of capital, not just for U.S. firms, but globally. Companies in emerging markets that rely on foreign debt, for example, could face stiffer terms.
And that would slow down investments and potentially contribute to a stock market pullback there.
Precisely. It's a big reminder that even though we often look at bonds, equities, and crypto in isolation, they are all incredibly interconnected.
Right. In today's globalized financial ecosystem, a shift in one sector can quickly ripple through many others.
Absolutely. Now let's pivot to the ever-evolving world of crypto.
Yes. I hear the Senate is gearing up for a vote on legislation that could reshape the stablecoin industry.
That's the buzz. Stablecoins, for those who might not know, are cryptocurrencies designed to maintain a stable value, usually by being pegged to something like the US dollar.
Got it. And this proposed bill, what's the potential impact?
It's generating a lot of buzz because it has the potential to really turbocharge innovation in this niche market. But it also aims to set a regulatory framework that balances investor protection with market growth.
Okay, so high expectations on Capitol Hill then.
Very high. Some analysts think this could be the catalyst the crypto market needs, especially given the steady gains we're seeing in major coins like Bitcoin and Ethereum.
It's kind of like when new rules in one market unexpectedly create opportunities in another. Like adding a little lemon to your water might just add that extra zing.
Haha, I like that analogy. But, there's always a flip side.
True, increased regulatory scrutiny often means a more complicated compliance maze for companies, right?
Exactly. The balance here is delicate. Too much regulation, and you risk stifling innovation. Too little, and you expose investors to unnecessary risks.
It's like cooking a gourmet meal. You need just the right amount of salt, the regulation, to bring out the flavor of innovation without making it a bland dish.
Perfect analogy. Finding that sweet spot is key.
Now, in other news-making waves, JPMorgan has taken a pretty bold step, haven't they?
They have. They've launched what they're calling a Special Forces unit.
Special Forces? That sounds serious. What's the mission?
It's a targeted initiative designed to protect investors from the increasing political risks that are a byproduct of our highly uncertain global environment.
Okay. Jamie Dimon, JPMorgan's CEO, has been talking about this, hasn't he? He highlighted in his annual letter that we're facing one of the most perilous geopolitical and economic climates since the mid-20th century.
He did. And this move to create a specialized team really reflects the bank's proactive stance in anticipating political headwinds that could affect market stability.
It is quite interesting to see a financial giant essentially gearing up with what looks like a task force, almost like a real-life action movie team, but for finance.
Right, their mission is to assess risks, advise clients, and take rapid action when necessary to safeguard investments.
So in a sense, it's a signal to the market that caution is warranted, and that institutions are preparing to intervene if needed.
Exactly. Some might say it echoes a broader trend where big banks are really stepping up their game amid rising political uncertainties.
It really gets you thinking. In a world where fiscal policy and geopolitical maneuvers can shift on a dime, can traditional risk management strategies even keep up with the pace of change?
That's a huge question. Let's try and break these stories down into a format that's easy to digest, because we've covered quite a number of them.
Good idea.
First, we have those recurring headlines on the 30-year Treasury yield. This story's been repeated everywhere, emphasizing the key message. Government debt is under pressure, and yields over 5% are a signal, not just a metric.
And with that repeated coverage, the market sentiment definitely leans toward caution. Investors really need to ask themselves, what does a higher yield mean for corporate debt standards? How might this impact those highly leveraged sectors?
Right. It poses questions about the economic outlook for both companies and consumers. Second, the tale of the Bond Vigilantes has seen similar repetition globally.
They're a sign of investor impatience and fear, aren't they? Their actions remind everyone that when fiscal imbalances exist, the market isn't shy about signaling distress.
Exactly. They serve as the conscience of the market, in a way. And those increased yields could lead to tighter credit conditions, potentially slowing down economic growth, especially in emerging markets.
So if you're an investor, consider if your portfolio is overexposed to assets that might be negatively affected by higher borrowing costs.
Good point. Third, we have the exciting developments on Capitol Hill regarding stablecoin regulations. That proposed crypto bill really stands out as a potential game changer.
There's talk it might not just refine the rules, but also open up new avenues for growth in the crypto sector. The fact that it's getting coverage across multiple outlets underscores its significance.
Definitely. It's an area where innovation and regulation are doing that delicate tango we talked about, a dance that will ultimately dictate the future of digital finance.
Will the government find the right balance between fostering innovation and protecting investors? Or will the scales tip too far, one way or the other?
That's the big question there. Fourth, JPMorgan's initiative to set up that, quote, Special Forces unit. That's another critical development.
Seeing an institution of that stature proactively addressing political and geopolitical risks is a strong reminder that we're living in unprecedented times.
It really highlights a trend where the lines between traditional finance and risk management are blurring. Banks are stepping beyond conventional roles.
Yeah, JP Morgan's unit is a perfect example of that trend. It just reinforces that in uncertain times, investors need financial institutions to be not just custodians of capital, but trusted advisors capable of navigating unpredictable risks.
Absolutely. Now that we've covered these headline stories, let's transition into a detailed sector analysis.
Okay, where should we start?
Let's look at technology. The Nasdaq's performance today suggests investors still favor high-growth tech companies, despite the broader market's mixed signals.
Right. Innovation drives so much progress, and these firms often command a premium in investors' minds.
True, but with rising bond yields, there is potential pressure on tech companies that rely on significant capital expenditure. Higher borrowing costs could tighten profit margins over time.
Good point. That's something investors should definitely keep an eye on. It reminds me of that joke, why did the tech startup go to therapy?
Oh, I know this one. Why?
Because even in the cloud, it couldn't escape its debt issues.
Haha, perfect. Okay, turning our attention to the energy sector. Prices have been relatively volatile, partly due to geopolitical risk and global uncertainties.
And how do the rising yields play into that?
Well, on one hand, they could slow down investment in new energy projects because of higher financing costs. But on the other, energy companies with strong balance sheets might see this as an opportunity to consolidate and grow.
So a classic case of risk and reward. The same factors causing caution in one part of the market might create opportunities in another.
Exactly. Energy is still a sector where traditional fundamentals and modern considerations, like green energy initiatives, intersect in fascinating ways.
And the financial sector is obviously in the spotlight today with JP Morgan's move.
Definitely. As banks navigate this labyrinth of political and economic uncertainty, we're seeing that proactive risk management isn't just a nice-to-have, it's a necessity.
With rising bond yields and heightened concerns over political instability, banks are definitely gearing up to protect their portfolios and guide clients through choppy waters.
JP Morgan's, quote, Special Forces unit is a prime example of this. It just serves as a reminder that in uncertain times, investors need financial institutions to be not only custodians but also trusted advisors.
Right, and globally, these trends are painting a picture of interconnected risks and opportunities.
They really are. The rise in global bond yields driven by Bond Vigilantes and widening fiscal concerns is something we just can't ignore.
For instance, as the Fed and other central banks weigh their policy options, higher yields could feed into inflation expectations, exchange rate fluctuations, and ultimately, global capital flows.
Precisely. Emerging market economies, in particular, might suffer from increased borrowing costs and capital outflows, potentially leading to slower growth and heightened vulnerability.
So it's a balancing act. While investors chase yield, they also have to be wary of the consequences that come with it.
Absolutely. This confluence of market developments really raises some interesting questions for all of us.
Like what?
Well, how exactly will a tighter fiscal environment impact corporate earnings in the coming months? With rising bond yields and potential headwinds in the credit markets, are we headed for a recalibration of asset values across sectors?
And what about that emerging regulatory landscape in crypto? Could we see a surge in stablecoin innovation as compliance hurdles are clarified? Or will the increased oversight stifle that entrepreneurial spirit?
Exactly. Big questions. Now, let's add in some expert insights to round things out.
Okay.
Many of my colleagues believe the current environment is one of cautious optimism. The modest gains in major equity indexes, paired with stable performance in certain sectors, suggest that while investors are vigilant, there's still confidence in the underlying fundamentals.
I was talking to an expert earlier who mentioned that the markets are sending mixed messages. There's an undercurrent of doubt in bond markets and an exuberance in tech, but taken together, they hint at a complex yet resilient economic framework.
That dichotomy between risk and opportunity is always fascinating, isn't it? On one hand, rising bond yields and fiscal pressures are a cautionary tale.
But on the other, innovative sectors like technology and digital currencies, continue to show remarkable growth.
It really brings to mind that old adage, never put all your eggs in one basket. Diversification right now isn't just a strategy. It feels like a necessity for survival in this volatile landscape.
Good point. Investors are well advised to weigh their options carefully, balancing traditional markets with new frontiers, and always keeping an eye on that evolving risk environment.
Absolutely. I want to take a moment just to reflect on the times we're living in.
Go for it.
We're in an era where political risks are as tangible as economic indicators. With things like JPMorgan's special unit and rising concerns from Washington about debt and fiscal policy, the backdrop for investors has become markedly complex.
It really has. Sometimes it feels like managing a portfolio is akin to juggling flaming torches while riding a unicycle on a tightrope.
Haha. And honestly, if that isn't a conversation starter at your next dinner party, I don't know what is.
Definitely adding that one to the repertoire. So let's quickly summarize these essential takeaways for everyone.
Okay. First, the equity markets are in a cautious upward mode, with tech really leading the charge despite a mixed performance overall.
Second, the bond market is sending a clear warning of potential credit stress with rising yields. That's something you really shouldn't take lightly, especially given those global fiscal challenges.
Agreed. Third, regulatory developments in the crypto space and proactive risk management by major financial institutions underscore that investor protection is high on the agenda right now.
And finally, sector-specific trends, whether it's technology, energy, or finance, they're constantly evolving, presenting both opportunities and challenges that require diligent monitoring.
Absolutely. Before we wrap up, I'd love to leave you with a few thought-provoking questions.
Lay them on us.
How will rising yields impact your portfolio strategy? Are you prepared for potential adjustments in credit markets and their ripple effects across global assets?
And what's your take on that balance between regulation and innovation in the crypto space? It's a hot topic.
Exactly. These are great questions for our community of savvy investors and traders to mull over. We encourage you to share your insights and join the conversation with our AI co-pilot at PantheonAI.
Definitely. As we wrap up today's briefing, remember that no matter how complex and fast-changing the market landscape may be, PantheonAI is here to serve as your information co-pilot,
guiding you through the intricacies with clarity, precision, and hopefully a dash of humor, as we tried today.
It's been a pleasure walking through these market insights, news updates, and deep dives with you this morning.
Thanks so much for joining us today. We invite you to come back for the next episode tomorrow, where we'll unravel even more layers of today's market dynamics and help you navigate the investment landscapes with fresh perspectives.
And if you have any questions or need further insights, don't hesitate to ask our AI co-pilot. We're really here to help.
Remember, learning shouldn't feel like a full-time job.
Exactly. Have a great day, stay thoughtful, and happy investing. PantheonAI, your information co-pilot.
Because learning shouldn't feel like a full-time job. Take care and see you next time.